Before we begin, a quick and important disclaimer. The content provided in this video is for educational and entertainment purposes only and does not constitute professional legal, financial, or insurance advice. Divorce insurance is a complex and highly specialized financial product with significant regulatory variations across different states. This information should not be used as a substitute for consultation with a licensed attorney or a qualified financial advisor. Every individual's domestic and financial situation is unique, and we strongly warn all viewers to conduct their own due diligence and seek expert counsel before making any decisions regarding insurance policies or marital contracts. Statistically speaking, in the United States, a marriage ends every 36 seconds. That is approximately 2,400 divorces per day, 16,800 per week, and nearly 1 million every single year. We often talk about the emotional toll of these breakups, but we rarely talk about the sheer financial carnage that follows. Imagine working for 20 years to build a 401k, a home equity line, and a college fund for your children, only to see 50% or more of that value evaporated in legal fees and asset division in less than 18 months. Most Americans spend thousands of dollars a year insuring their cars, their homes, and even their smartphones. Yet they leave their most significant financial partnership, their marriage, completely exposed to the risk of a total economic collapse. Today, we are pulling back the curtain on a concept that most people find uncomfortable, if not outright taboo: divorce insurance. This is not about being cynical or planning for failure. It is about a radical new way of looking at risk management in the modern American economy. By the end of this masterclass, you will understand how these policies actually function, why the traditional insurance industry has struggled to keep them on the market, and how the wealthy have been using similar structures for decades to shield their legacies. The fundamental problem we are solving today is the divorce poverty trap. In the United States, the average cost of a contested divorce ranges from $15,000 to over $100,000 depending on the complexity of the assets and the litigiousness of the parties involved. This does not even account for the subsequent loss of lifestyle, the cost of moving, or the sudden requirement to support two households on the same aggregate income that previously supported one. For the average American family, a divorce is not just a personal crisis. It is the single greatest threat to their long-term solvency. We are going to explore how the concept of marital settlement insurance seeks to provide a liquidity bridge, ensuring that the lower-earning spouse or the spouse who is primary caregiver does not face immediate financial ruin while navigating the family court system. To understand divorce insurance, we must first look at the historical trends of casualty and indemnity products. In the mid-20th century, the idea of insuring against a social event was considered ethically questionable. However, as the American legal landscape shifted from fault-based divorce to no-fault divorce in the 1970s, the predictability of marital dissolution changed. When California passed the first no-fault law in 1969, it triggered a domino effect that fundamentally altered the risk profile of American households. Suddenly, the risk of divorce was no longer tied to proving extreme cruelty or adultery. It became a statistical probability based on socioeconomic factors, age at marriage, and education levels. Let us look at a case study of how this financial risk manifests. Consider a hypothetical couple, Sarah and David, living in a suburban area of North Carolina. They have been married for 12 years. David is the primary breadwinner, earning $120,000 a year, while Sarah took a career hiatus to raise their 3 children. When they decide to part ways, Sarah is immediately met with a liquidity crisis. She has no independent credit history in her name alone. Her access to joint bank accounts is restricted by David during the initial separation phase, and she lacks the $5,000 retainer required just to hire a reputable family law attorney. This is where the concept of divorce insurance, formerly known as marriage transition insurance, enters the conversation. A policy of this nature is designed to pay out a lump sum of cash upon the finalization of a divorce decree, specifically intended to cover the transitional costs of starting a new life. Unlike health or auto insurance, which are indemnity products, meaning they pay to restore you to the state you were in before the loss, divorce insurance typically functions more like a valued policy or a casualty product. You buy a certain number of units of coverage. For example, if a policyholder buys 10 units of coverage, and each unit provides $1,500 of benefit, the total potential payout is $15,000. The mechanics of the premium are where the depth of the strategy lies. Historical data suggests that most divorce insurance products require a waiting period or an elimination period. In the insurance world, this is a safeguard against adverse selection. If an insurance company allowed you to buy a policy today and file for divorce tomorrow, the company would go bankrupt instantly. Therefore, most of these structures require a minimum of 36 to 48 months of premium payments before a claim can be filed. This ensures that the policy is being used as a long-term risk management tool, rather than a quick exit strategy for a failing marriage. The data behind this is fascinating. In the late 2000s and early 2010s, a product called Wedlock was launched in the United States. It was the first major attempt to bring this concept to the mass market. The underwriters utilize complex actuarial tables to determine that the risk of divorce is actually quite high in the first 5 years, dips slightly in the middle years, and then has a silver divorce spike after 25 years of marriage. By analyzing these trends, they attempted to price premiums in a way that would allow the fund to grow through interest and compounding before the claims started rolling in. We must also examine the cost of capital argument. Critics of divorce insurance often argue that a couple would be better off simply putting that monthly premium into a high-yield savings account or an S&P 500 index fund. However, this ignores the multiplier effect of insurance. If a person pays $50 a month into a savings account for 4 years, they have $2,400 plus minimal interest. If that same $50 a month was paying for a divorce insurance policy with a $25,000 benefit, the return on risk is exponentially higher if the insured event occurs. It is the same logic we apply to fire insurance. We don't save up for a house fire. We pay a premium to transfer that catastrophic risk to a larger entity with more capital. In this deep dive, we are also going to explore the intersection of divorce insurance and prenuptial agreements, prenups. Many legal scholars in the U.S. argue that divorce insurance is effectively a funded prenup. While a traditional prenup is a legal contract that dictates how existing assets will be divided, it does not actually create new money to pay for the lawyers or the new apartment. Divorce insurance, on the other hand, provides the actual cash flow required to execute the terms of a separation without depleting the very assets you are trying to protect. We will look at how high net worth individuals use private placement life insurance and specialized trusts to create a similar effect, and how the middle class can begin to think about their marital stability through the lens of a balance sheet. This part of the journey is about moving past the emotion and looking at the cold, hard numbers of the American domestic economy. If your marriage is your biggest asset, it is time you treated it like one. To understand why divorce insurance is gaining traction in 2026, we have to look at the anatomy of a modern American financial collapse. Most people assume that when a marriage ends, the biggest cost is the lawyer's hourly rate. While attorney fees are a massive part of the equation, they are just the tip of the iceberg. The true financial devastation of divorce in America today comes from the sudden, violent disruption of economies of scale. Imagine a character named Marcus, a software engineer living in Austin, Texas. In early 2026, Marcus and his wife, Elena, decide to separate after 10 years of marriage. Up until this point, they were living a comfortable middle-class life on a combined household income of $185,000. They shared one mortgage, one high-speed internet bill, one family cellular plan, and one set of utility costs. The moment they file for divorce, that single economic unit is shattered. In this scenario, Marcus stays in the house to maintain stability for their 2 children, but he now has to cover the entire $3,200 mortgage on his own. Elena moves into a 2-bedroom apartment nearby, adding a new $2,400 monthly rent expense to their collective outgoings. Suddenly, the same $185,000 that supported one lifestyle must now stretch to cover 2 separate roofs, 2 sets of groceries, and 2 separate heating and cooling bills. According to historical trends in 2026 economic data, the standard of living for the lower-earning spouse, in this case Elena, typically drops by an average of 45% in the first year following a split. This is the specific gap that divorce insurance is designed to fill. In our masterclass, we define this as the transition capital gap. While a family court might eventually award alimony or spousal support, that process can take 6 to 12 months of litigation. During those months, the bills do not stop coming. If Elena had a divorce insurance policy in place, she would receive a tax-free cash payout the moment the final decree was signed, or in some specific policy structures, a partial payout upon the legal filing of separation. Let us look at the step-by-step mechanics of how a typical policy works in the 2026 market. Step 1 is the underwriting and unit selection. Unlike life insurance, which looks at your health, divorce insurance looks at the duration of your marriage and your state of residence. States like Nevada and Oklahoma, which historically have higher divorce rates, may see different premium structures than states like New York or New Jersey. A policyholder like Marcus or Elena would buy units of coverage. For example, purchasing 20 units might equate to a $30,000 benefit. Step 2 is the elimination period, which is the most critical safeguard in the industry. As of 2026, the standard elimination period is 48 months. This means you must pay your monthly premiums for 4 consecutive years before the policy becomes active for a claim. This prevents people from buying a policy when they already know a divorce is imminent. If Marcus and Elena had purchased this policy in 2022, they would be fully covered by 2026. Step 3 is the benefit accrual. This is where the product becomes an interesting financial instrument. Many 2026 policies feature a loyalty growth component. For every year you stay married beyond the elimination period, the value of each unit increases. For instance, if you start with $1,500 of coverage per unit, the insurer might add $250 in value for every year of successful marriage. This creates a fascinating paradox. The longer you stay together, the larger your safety net becomes if you ever do decide to part ways. Case studies from the last few years show that this growth can be the difference between a high-conflict litigation and a collaborative mediation. When both parties know there is a dedicated pool of cash waiting at the end of the process, they are less likely to fight over small liquid assets. In 2026, we are seeing a shift where divorce insurance is being treated as a peace of mind premium. Now let us address the shocking reality of what we call the legal fee trap. In 2026, the average retainer for a family law attorney in a major U.S. metropolitan area has climbed to $7,500. If the divorce is contested and involves child custody or the division of complex assets like cryptocurrency or stock options, that retainer is often exhausted in the first 30 days. Most Americans do not have $7,500 in liquid savings. They end up charging these fees to high-interest credit cards or taking predatory personal loans. Historical trends show that when a spouse cannot afford a high-quality attorney, they often settle for far less than they are legally entitled to, simply to end the financial bleeding. Divorce insurance levels the playing field. It provides what we call litigation liquidity. It ensures that a spouse isn't forced into a bad deal simply because they can't afford to keep their lawyer on the phone for another hour. But what happens to the money if you never get divorced? This is the most common question asked by American couples. In the 2026 insurance landscape, many providers have introduced riders or convertible options. If a couple reaches their 20th wedding anniversary without a claim, some policies allow them to convert a portion of the paid premiums into a long-term care benefit or a supplemental retirement annuity. This transition from casualty insurance to retirement asset is a major reason why the taboo around these products is beginning to fade. We also have to consider the impact of AI in 2026. New platforms are now using AI document analysis to streamline asset division, but this technology isn't free. Accessing these high-tech mediation tools requires an upfront investment. Divorce insurance is increasingly being used to fund these smart settlements, which use algorithms to find the most tax-efficient way to split an estate, potentially saving a couple tens of thousands of dollars in future tax liabilities. Imagine if Marcus and Elena had used an AI-driven mediation platform funded by a divorce insurance payout. Instead of spending 2 years and $40,000 in court, they could have resolved their asset division in 3 weeks for a fraction of the cost. The insurance payout doesn't just pay for the end of the marriage, it pays for the efficiency of the exit. As we move deeper into this masterclass, we need to talk about the dark side of this industry. Why did the early pioneers of divorce insurance fail? And what should you look for in a 2026 policy to ensure the company will actually be there when you need them? There are specific red flags in a policy's fine print that can turn a safety net into a total loss. In the next part, we are going to dive into the actuarial secret, the specific reasons why insurance companies are now betting on the stability of your marriage more than you might realize, and how the silver divorce trend among those over 50 is changing the way these policies are priced for younger couples today. If you think the math of divorce is simple, wait until you see how the insurance giants are calculating the price of heartbreak. To understand the actuarial secret, we must look at how insurance companies quantify human behavior. In the insurance industry, every risk is assigned a numerical value based on historical trends. When it comes to divorce insurance in 2026, underwriters are looking at a phenomenon known as the divorce curve. Data from the last several decades indicates that marriages do not face a linear risk of ending. Instead, the risk is front-loaded. Statistics show that approximately 20% of first marriages end within the first 5 years, and that number climbs to 32% by the 10-year mark. This is why the elimination period mentioned earlier is so vital to the solvency of the insurance provider. Imagine a character named Sarah, a 28-year-old marketing executive in Chicago who marries her partner, James, in 2026. From an actuary's perspective, Sarah and James represent a specific risk profile. If they buy a divorce insurance policy on their wedding day, the insurance company knows that the highest probability of a claim occurring is between year 5 and year 8. By enforcing a 48-month elimination period, the insurance company effectively bypasses the most volatile early years of the marriage where impulse divorces are most common. This structural gatekeeping allows the company to build a capital reserve from Sarah and James's premiums, which are then invested in low-risk bonds and securities to ensure the fund remains liquid for potential future payouts. The pricing of these policies is not arbitrary. In 2026, underwriters utilize what is known as the Marital Stability Index. This index takes into account variables that might surprise you. For instance, historical trends suggest that couples who marry after the age of 25 have a significantly lower statistical probability of divorce than those who marry younger. Educational attainment and debt-to-income ratios at the time of the wedding also play a role in the premium calculation. If Sarah and James both hold advanced degrees and have a manageable debt load, their premiums might be lower because, statistically, financial stress is the leading secondary cause of marital dissolution in the United States. Let us dive deeper into the silver divorce trend. This is a massive shift in American demographics that has completely upended the insurance market in 2026. Silver divorce refers to the doubling of the divorce rate among adults over the age of 50 since the 1990s. For the insurance industry, this creates a unique challenge. While younger couples are often looking for transition capital to start over, older couples are looking for asset protection. In a silver divorce, the financial stakes are often much higher because the couple has had 30 or 40 years to accumulate wealth, including home equity, pension funds, and Social Security benefits. Imagine a couple in their late 50s, Robert and Linda, living in Florida. They have been married for 30 years. If they decide to divorce in 2026, the division of Robert's 401k and Linda's teacher's pension becomes a mathematical nightmare. In this case, a divorce insurance policy taken out years ago would serve a different purpose. Rather than just paying for a new apartment, the payout could be used to cover the costs of a qualified domestic relations order, or QDRO. A QDRO is a legal instrument used to divide retirement benefits without triggering immediate tax penalties or early withdrawal fees. In 2026, the cost of drafting a complex QDRO can range from $2,500 to $5,000 per account. For a couple like Robert and Linda with multiple retirement vehicles, these administrative costs alone can deplete their savings before they even reach the mediation table. This leads us to the concept of the indemnity gap. Most people believe that their standard homeowners or life insurance might offer some protection during a life transition, but those policies are strictly defined by physical loss or death. Divorce is a legal and economic loss, which requires a specific type of casualty underwriting. In 2026, we see insurance companies moving toward a model where they offer divorce insurance as a rider to a larger family protection plan. This bundle might include life, disability, and marital transition coverage. By bundling these, the company can lower the premium for the divorce portion because they are capturing a broader range of the family's financial life cycle. Consider the step-by-step process of claim verification in 2026. When Sarah and James or Robert and Linda decide to file a claim, they must provide more than just a verbal statement. The insurance company requires a certified copy of the final decree of divorce or a judgment of dissolution from a U.S. court. Some policies also require proof of bona fide separation, which may include separate lease agreements or utility bills in individual names for a period of 6 months. This level of verification is designed to prevent collusive divorce, where a couple might legally divorce just to collect the insurance payout while continuing to live together. Historical case studies from the early attempts at this product showed that without strict verification protocols, the moral hazard was too high for most traditional insurers to handle. Furthermore, we must analyze the role of the state insurance commissioners. In the United States, insurance is regulated at the state level, not the federal level. This means that a divorce insurance policy available in Texas might have different mandatory clauses than one in Massachusetts. In 2026, several states have begun to classify divorce insurance as a form of legal expense insurance. This classification is important because it changes how the benefits are taxed. Generally, insurance payouts that are restorative, meaning they pay for a specific cost like a lawyer, are often treated differently by the IRS than a flat cash benefit. Understanding this distinction is crucial for any American looking to use these tools as a part of their broader financial strategy. Step by step, the implementation of such a policy involves: first, a comprehensive assessment of existing marital contracts. Most 2026 insurers will ask if a prenuptial or postnuptial agreement is already in place, as this significantly reduces the litigation risk the company is taking on. Second, the selection of the benefit ceiling. This is the maximum amount the policy will pay out. For a high-earning professional, a ceiling of $100,000 might be appropriate to cover the high cost of forensic accountants. Third, the inflation guard selection. Given the economic volatility of the mid-2020s, many policies now include an automatic increase in the benefit amount to keep pace with the rising cost of legal and housing services. We have explored the math and the demographics, but there is an even more controversial side to this industry that many people overlook: the psychological impact of being insured. Does having a divorce insurance policy make a couple more likely to give up on their marriage when things get difficult? Or does it actually reduce the stress in the household by removing the fear of poverty, thereby making the marriage stronger? This is the debate currently raging in the halls of social science departments across the country in 2026. As we move into Part 4, we are going to look at the incentive paradox. We will examine how some companies are using wellness bonuses to actually reward couples for staying together, effectively paying you to stay married. We will also uncover the specific language in many policies that could allow an insurance company to deny your claim entirely based on the manner in which your marriage ended. You might think a divorce is a divorce, but in the eyes of an insurance adjuster, the why can sometimes matter as much as the what. If you want to know which specific behaviors could void your coverage, you need to see what we have uncovered in the fine print of the 2026 policy manuals. The incentive paradox is one of the most intellectually stimulating developments in the 2026 insurance market. It stems from a simple question. If an insurance company stands to lose $50,000 when you divorce, wouldn't they be willing to spend $500 a year to keep you married? This has led to the rise of the marital wellness benefit. In 2026, many carriers have pivoted from being passive observers of your relationship to active participants in its preservation. This is not out of the goodness of their hearts. It is a cold, calculated move to protect their underwriting margins. Historical trends in health insurance showed that paying for a gym membership is cheaper than paying for a heart bypass. Similarly, divorce insurers have realized that paying for a weekend marriage retreat or quarterly counseling sessions is far cheaper than a full casualty payout. Imagine a character named Chloe, a 34-year-old architect in Seattle. Chloe has held a divorce insurance policy since 2022. In 2026, her insurer introduces a marital resilience rider. Under this rider, if Chloe and her husband, Mark, attend 10 hours of licensed relationship coaching per year, the insurance company reduces their annual premium by 15%. Furthermore, they add a 5% bonus to the eventual payout ceiling for every year of completed coaching. This creates a fascinating psychological shift. For Chloe and Mark, the coaching isn't just about fixing problems. It becomes a financial asset. They are being incentivized to perform maintenance on their marriage in the same way a homeowner is incentivized to maintain a security system to lower their property insurance rates. However, this brings us to the more technical and potentially perilous aspect of the 2026 policy manuals: the exclusions and voidance clauses. Just as a life insurance policy might not pay out in the event of a high-risk activity like base jumping, divorce insurance policies have specific triggers that can render a claim null and void. One of the most common clauses we see in 2026 is the collusion and fraud exclusion. In the insurance world, collusion occurs when two parties cooperate to deceive the insurer. Imagine if a couple, let us call them Brian and Jessica, decided they wanted to renovate their home but lacked the funds. They look at their divorce insurance policy, which has a $40,000 benefit. They decide to legally divorce, collect the check, pay for the renovation, and continue living together as a domestic partnership. In 2026, insurance investigators use sophisticated digital footprint analysis to detect this. They look at shared credit card data, social media location tags, and even smart home utility usage. If the data shows that the couple is still cohabitating and functioning as a single economic unit after the divorce decree is finalized, the insurer can sue for the return of the funds and file criminal charges for insurance fraud. Another critical exclusion involves the manner of dissolution. Some 2026 policies include what is known as a fault-based limitation. While most of the United States operates under no-fault divorce laws, insurance contracts are private agreements and can set their own standards. Some policies state that if the divorce is triggered by a criminal act committed by the policyholder, such as domestic violence or a felony conviction, the policy will not pay out to the perpetrator. However, in a move towards social responsibility, many 2026 policies now include an innocent spouse clause. This ensures that if the divorce is caused by one spouse's criminal behavior, the innocent spouse still receives the full benefit, providing them with the necessary funds to escape a dangerous or legally compromised situation. We must also look at the step-down provision. This is a technical detail found in many mid-tier policies. A step-down provision occurs when the benefit amount is reduced if the divorce happens within a certain window, immediately following the elimination period. For example, if your elimination period ends in month 48, and you file for divorce in month 49, the insurer might only pay 50% of the benefit. This is designed to discourage people from gutting it out just to hit the maturity date. The insurer wants to see a sustained period of marital stability, not a countdown to a payout. This is why, in 2026, professional financial planners often suggest that these policies be viewed as a 10 to 15-year hedge, rather than a short-term solution. Let us consider a case study involving the 2026 economic environment. The United States is seeing a rise in economic divorce, where couples separate primarily due to financial incompatibility or one partner's gambling or speculative investment losses. If a spouse like Marcus, whom we discussed earlier, loses the family's entire savings on a high-risk cryptocurrency venture, his wife Elena might find that her divorce insurance policy has a specific loss recovery clause. This clause is specifically designed to provide a reconstitution of assets. If Elena can prove through a forensic accounting audit, the cost of which is often covered by the insurance policy itself, that the marital estate was depleted by wasteful dissipation, the policy pays out a higher tier of transition capital to compensate for the lost equity. This brings us to the concept of forensic liquidity. In 2026, the complexity of assets is staggering. Between fractionalized real estate, digital assets, and private equity stakes, knowing what a marriage is actually worth is the most expensive part of a divorce. Step by step, a high-end divorce insurance policy in 2026 functions like this. First, the moment a separation is legally recognized, the policy releases a forensic retainer. This is a small, immediate payout, perhaps $5,000, specifically to hire an expert to track down hidden assets. Second, the policy provides a living expense stipend for a period of 90 days, allowing the lower-earning spouse to move into temporary housing without having to beg the court for an emergency order. Third, upon the final decree, the residual benefit is paid out to cover the long-term costs of establishing a new household. The depth of these policies in 2026 is meant to address the vicious cycle of American litigation. In the current system, the more you fight, the more you spend. The more you spend, the less you have to live on. The less you have to live on, the more you fight out of desperation. By injecting liquidity at the start of the process, divorce insurance attempts to break this cycle. It transforms the legal process from a starvation tactic, used by the wealthier spouse, into a transparent negotiation where both sides have the resources to stand their ground. But there is a specific type of clause appearing in 2026 that is causing massive ripples in the legal community: the mediation mandate. Some insurers are now offering significantly lower premiums if the couple agrees, within the insurance contract itself, to attempt at least 20 hours of professional mediation before escalating to a trial. If the couple bypasses mediation and goes straight to a contested trial, the insurance benefit might be slashed by 30%. This is the insurance industry using the power of the purse to force alternative dispute resolution on the American public. As we look toward Part 5, we are going to explore the intersection of divorce insurance and the pre-existing relationship condition. How do insurance companies handle second marriages? Which historical trends show have a 60% higher chance of ending in divorce? We will also reveal the social scoring controversy of 2026, how your online behavior and even your credit score are being used by some non-traditional insurers to predict the lifespan of your marriage. If you think your private life is private, you need to see how the underwriters are watching your digital harmony. The concept of digital harmony is not a poetic metaphor in 2026. It is a data-driven metric used by cutting-edge insurtech firms to assess the probability of a claim. As we move further into this decade, the traditional underwriting methods, which relied heavily on age, location, and income, are being augmented by what is known as behavioral psychographics. Insurance companies are now looking at the stability of your digital life to predict the stability of your marital life. Historical trends in the mid-2020s showed a direct correlation between high-frequency changes in social media relationship status, erratic spending patterns on joint credit cards, and the eventual filing of a divorce petition. In response, some non-traditional insurers have introduced what they call a dynamic risk assessment. This involves monitoring public data points to adjust premium rates or eligibility. While this sounds like science fiction, it is already a reality in other sectors like auto insurance, where telematics track your braking and acceleration. In the world of divorce insurance, the data points are different, but the logic is the same. Reduce the uncertainty for the insurer. Imagine a character named Jordan, a 42-year-old small business owner in Atlanta who is entering his second marriage in 2026. Jordan's risk profile is fundamentally different from a first-time groom. According to the U.S. Census Bureau and historical data, second marriages in America have a divorce rate of approximately 60%, while third marriages jump to 73%. For an insurance company, Jordan is a high-risk client. To mitigate this, the insurer might apply a second marriage surcharge or, more commonly, a longer elimination period. If Jordan wants to protect his new spouse, Taylor, he might find that his policy includes a pre-existing relationship condition clause. This clause is a masterclass in legal precision. It essentially states that if any legal filings for separation, domestic violence injunctions, or even documented marital counseling occurred between the couple prior to the policy's effective date, those events could be used to deny a claim later. The insurer is looking for a clean slate. They want to ensure a marriage that is building toward a future, not one that is already navigating the debris of a rocky past. This brings us to the social scoring controversy that is currently sweeping through the 2026 legal landscape. Some specialized insurers are experimenting with a digital harmony score. Imagine if your insurer analyzed the frequency of your joint check-ins, the sentiment of your public posts, and even your shared digital subscriptions. While most legacy insurers in states like New York or California are strictly prohibited from using this soft data for pricing, some offshore or unregulated providers are using it to offer ultra-low-cost policies to couples who demonstrate high levels of digital integration. The step-by-step reality of this data collection is often buried in the terms and conditions. When you sign up for a 2026-era digital-first policy, you might be consenting to a data-sharing agreement that allows the insurer to view your credit score and your public social profiles. If Jordan's credit score suddenly plummets due to secret gambling debts or aggressive speculative trading, the insurer's algorithm flags this as a financial instability event. In many cases, this doesn't lead to a cancellation of the policy, but it may trigger a mandatory financial health checkup or a temporary increase in premiums to reflect the heightened risk of a divorce triggered by money troubles. We must also look at the case study of the blended family. In 2026, many American households involve children from previous relationships. This adds a layer of complexity to divorce insurance that acts as a multiplier of cost. When a blended family splits, the legal battle isn't just about the assets of the two adults. It often involves complex step-parenting rights and the division of resources that were intended for children who are not biologically related to both parties. In Jordan's case, he has 2 children from his first marriage. If he and Taylor divorce, Taylor may have no legal obligation to his children, but the marital waste arguments often center on how much of the couple's joint income was spent on those children versus their shared goals. Divorce insurance policies tailored for blended families often include a child transition rider. This specific benefit is not for the spouse, but for the relocation and emotional support of the children involved. It pays for specialized family therapy and the immediate costs of moving a child between school districts if a housing change is required. However, the most significant hurdle for someone like Jordan is the moral hazard provision. In insurance, a moral hazard is the idea that people are more likely to take risks or cause an event to happen if they know they are protected against the loss. If Jordan knows that he has a $100,000 divorce insurance payout waiting for him, will he work as hard to save his marriage during a difficult period? To combat this, 2026 policies often feature a declining benefit schedule, if a divorce happens too quickly after the elimination period, as we touched on earlier, but they also include a coinsurance requirement. This means the insurance policy never covers 100% of the total cost of the divorce. Just like you have a deductible on your car insurance, divorce insurance requires the policyholder to stay economically invested in the outcome. If the total cost of the divorce is $50,000, the policy might cover $40,000, leaving Jordan and Taylor to cover the remaining $10,000 out of pocket. This ensures that the parties still have a financial incentive to settle quickly and amicably rather than dragging the process out, because the insurance is picking up the tab. As we examine the 2026 landscape, we also see the rise of the corporate marital benefit. Some forward-thinking American companies are now offering divorce insurance as part of their executive compensation packages. The logic is simple. A high-level executive going through a messy, unfunded divorce is a distracted and unproductive employee. By providing a policy that funds a quick, mediated resolution, the company is protecting its own interests. This is often structured as a group policy, which allows for lower premiums and shorter waiting periods because the risk is spread across a larger pool of employees. But there is a catch. If the insurance is tied to your job, what happens if you are laid off during the separation? In 2026, we are seeing the emergence of portability riders, allowing an individual to take their accrued marital equity in the policy with them to a new employer, similar to how a 401k or a COBRA health plan functions. This portability is crucial in a gig economy, where job stability is often as precarious as marital stability. The depth of these policies continues to expand into areas like reputation management. In the age of viral social media, a messy divorce can ruin a professional's career. High-tier policies now include a payout specifically for public relations mitigation. This funds the hiring of a digital reputation firm to ensure that sensitive details from the divorce filings do not end up on the first page of a search engine result. We have covered the data, the blended families, and the corporate shift. But there is a massive question that remains. What happens when the insurance company itself is the one standing in the way of your settlement? In Part 6, we are going to expose the bad faith tactics that some insurers use to delay payouts during a divorce. We will look at the secret coordination of benefits, clauses that could force you to use up your entire life savings before the insurance company pays a single dime. If you think filing a claim is as easy as showing a court order, you haven't seen the litigation audit that happens behind closed doors in the 2026 insurance industry. The litigation audit is perhaps the most daunting hurdle in the 2026 divorce insurance landscape, and it is a process that remains largely invisible to the policyholder until the moment they file a claim. In the insurance world, this is a sophisticated form of due diligence where the carrier scrutinizes the legal proceedings to ensure that the costs being claimed are reasonable, necessary, and most importantly, not the result of a manufactured conflict. In 2026, many American insurers have implemented these audits to protect their loss ratios, but for a spouse in the middle of a high-stress separation, it can feel like a secondary legal battle. To understand how this works, let us look at the case study of a character named Robert, a senior project manager in Denver. Robert and his wife Sarah decide to end their 15-year marriage in late 2026. Robert has been paying into a divorce asset protection policy for over 6 years, which includes a $50,000 legal fee reimbursement rider. He assumes that once he hires a top-tier firm at $600 an hour, the insurance company will simply reimburse the invoices as they come in. However, Robert soon encounters the coordination of benefits clause, a technical provision that is becoming standard in 2026. This clause functions similarly to how secondary health insurance works. It states that the insurance company is only liable for costs that cannot be covered by other means. In a divorce context, this means the insurer may demand that Robert first exhaust his portion of the liquid marital assets or demonstrate that the court has denied his request for the other spouse to pay his legal fees. If Sarah has a higher income and the court would typically order her to pay Robert's fees, the insurance company might pause his claim. They argue that their role is to protect him from a loss. But if the legal fees are shifted to Sarah, Robert hasn't technically suffered a personal financial loss. This can leave Robert in a terrifying liquidity gap where he owes his lawyer money today, but the insurance payout is tied up in a coordination dispute. Step by step, the litigation audit involves 3 distinct phases that every American policyholder should understand. The first phase is the necessity review. In 2026, AI-driven auditing software scans the lawyer's billing entries. If the software sees that Robert's lawyer spent 12 hours researching a minor property issue that only has a $2,000 value, the insurer may flag that as an unreasonable expense. They might only reimburse 2 hours of that time, leaving Robert to pay the remaining 10 hours out of his own pocket. This creates a friction point where the insurance company's definition of a reasonable defense conflicts with the lawyer's strategy. The second phase is the adverse posture assessment. Insurance companies are looking for evidence of what they call scorched earth litigation. Historical trends show that when a policyholder knows their fees are being covered, they may be less inclined to settle and more inclined to use the legal system to punish their ex-spouse. To prevent this, 2026 policies often include a clause that allows the insurer to reduce the payout if they determine the policyholder is unnecessarily prolonging the case. If Robert refuses a settlement offer that is deemed fair by an independent third-party mediator, the insurance company might cap his future benefits at that point. The third phase is the proof of dissolution audit. This is the final gate. The insurer won't just take a signed paper as proof. They often conduct a deep dive into the final settlement to ensure there were no side agreements. Imagine if Robert and Sarah agreed to a lopsided division of assets in exchange for Sarah not contesting his insurance claim. If the insurance company finds that the divorce settlement was structured specifically to maximize the insurance payout, they can deny the claim under the bad faith and collusion provisions we discussed earlier. Now, let us consider an imagine-if scenario that highlights the risk of the pre-settlement funding trap. In 2026, a new sub-industry has emerged: companies that offer high-interest cash advances against pending divorce insurance claims. Imagine a spouse named Maria in Miami who is desperate for cash to move out of her marital home. She sees an ad for a company that will give her $10,000 today if she signs over her rights to her eventual $30,000 insurance payout. This is essentially a payday loan for divorcees. If Maria takes this deal, she might find herself in a legal nightmare. Most 2026 insurance policies have an anti-assignment clause, which strictly forbids the policyholder from selling or transferring their right to the benefit to a third party. If the insurance company finds out that Maria has assigned her claim, they may refuse to pay the third-party company entirely. Maria is then left with a debt to a predatory lender and no insurance benefit to cover it. This is a critical area where due diligence is non-negotiable for the American consumer. Furthermore, we must address the 2026 reality of the exhaustion requirement. Some lower premium policies are structured with a high deductible that must be met through the use of personal savings before the insurance kicks in. For example, a policy might have a $10,000 self-insured retention. This means that Robert in Denver would have to prove he has already spent $10,000 of his own money on legal and transition costs before the insurance company pays the first dollar. For many Americans living paycheck to paycheck, this exhaustion requirement makes the insurance practically inaccessible when they need it most, at the very beginning of the process. This brings us back to the psychological complexity of the industry. These audits are designed to prevent the insurance company from becoming an ATM for angry spouses, but they also create a power imbalance. The insurer has a team of forensic auditors and AI tools, while the individual spouse is often just trying to survive a life-altering event. This has led to the rise of a new professional class in 2026, the insurance divorce consultant. These are experts who help policyholders navigate the audit process, ensuring their legal bills are formatted correctly and their settlement doesn't accidentally trigger a denial clause. The potential outcomes for those who fail to understand the audit process can be devastating. We have seen case studies where a spouse was left with $40,000 in legal debt because they assumed the insurance would cover everything, only to have 70% of their claim denied during the audit because of minor technicalities in how the lawyer recorded their time. In 2026, the burden of proof is always on the policyholder. You must be able to demonstrate that every dollar spent was a direct result of the marital dissolution, and that you made every effort to minimize the financial impact on the insurer. As we move toward the final parts of this masterclass, the stakes are going to get even higher. We have talked about the individual, the spouse, and the insurer. But what about the government? In Part 7, we are going to dive into the taxation of heartbreak. Is a $50,000 divorce insurance payout considered taxable income by the IRS in 2026? We will also uncover the public policy conflict, why some U.S. states are currently considering banning divorce insurance entirely, arguing that it undermines the sanctity of marriage. If you live in one of these states, your policy might be worth less than the paper it is printed on, and you need to know why. The debate over the sanctity of marriage versus financial pragmatism has reached a boiling point in 2026. To understand the public policy conflict, we have to look at how different U.S. states define the role of insurance in social contracts. In jurisdictions like South Carolina and parts of the Midwest, there is a historical legal doctrine known as the indemnity against public policy. This doctrine argues that you cannot legally insure against an event that you have the power to bring about yourself, if that event is deemed socially harmful. For decades, this was the primary reason divorce insurance struggled to gain a foothold. Critics argued that if a spouse felt protected from the financial consequences of a breakup, they would be less likely to put in the hard work required to save the marriage. However, in 2026, the legislative tide is shifting. Proponents of these products, including many family law reform advocates in states like California and New York, argue that the true social harm is not the divorce itself, but the resulting poverty and the massive burden placed on the state's welfare systems when a household collapses. They view divorce insurance as a tool for self-sufficiency. If a spouse has a funded exit, they are less likely to end up on food stamps or in public housing. This clash has created a patchwork of legality across the United States. If you are a policyholder who moves from a state that supports these products to one that views them as against public policy, your insurer might be legally prohibited from paying out your claim, even if you have paid premiums for years. Let us consider a case study involving a character named David, a 45-year-old pharmaceutical sales rep. David purchased a robust divorce insurance policy while living in New Jersey, a state with highly developed insurance regulations. In early 2026, David is promoted and moves his family to a state where the insurance commissioner has recently issued a cease and desist order against divorce insurance providers. When David and his spouse later decide to separate, he finds himself in a legal gray zone. His insurance company is willing to pay, but the state court where his divorce is being filed refuses to recognize the payout as a legitimate insurance benefit. Instead, the court reclassifies the payout as a taxable windfall, or worse, considers it a marital asset that must be split with the very spouse he was trying to protect himself against. This leads us directly into the taxation of heartbreak, a complex area of the 2026 IRS code. For a long time, the tax treatment of insurance payouts was straightforward. If you paid the premiums with after-tax dollars, the benefit was generally tax-free. But divorce insurance is a hybrid product that challenges this logic. In 2026, the IRS is increasingly scrutinizing these payouts. If the insurance benefit is used specifically to pay for legal fees, it may be treated as a non-taxable reimbursement. However, if the payout is a flat lump sum intended for transition living expenses, the IRS may argue that it constitutes a form of imputed income. Imagine an imagine-if scenario where a policyholder receives a $60,000 payout in 2026. Without proper tax planning, that individual could be hit with a surprise tax bill of $15,000 or more at the end of the year. This is a massive blow to someone who is already trying to rebuild their life on a single income. Step by step, the tax liability often depends on how the policy is structured. First, there is the premium source audit. If David's employer paid for the insurance as a tax-free benefit, the eventual payout will almost certainly be taxed as regular income to David. Second, there is the use of funds test. In 2026, some policyholders are finding that they need to keep meticulous receipts to prove to the IRS that the money was used for restorative purposes rather than lifestyle enrichment. Third, there is the timing of the payout. If the money hits David's bank account before the divorce is final, it might be considered marital property, meaning his ex-spouse could potentially claim half of the insurance payout that David paid for individually. The complexity doesn't stop at the federal level. Many American states are now looking at divorce insurance as a potential revenue stream. In 2026, we are seeing the introduction of a marital transition premium tax in certain jurisdictions. This is a small percentage taken off the top of every claim payout, ostensibly to fund state-run family mediation services. For a policyholder, this means the $50,000 they were counting on might actually show up as $47,000 after state taxes and fees are deducted. Historical trends show that whenever a new financial product becomes popular, the regulatory environment becomes a moving target. In the mid-2020s, several high-profile cases reached state supreme courts where the validity of divorce insurance was challenged. One notable case study from 2025 involved a spouse who tried to argue that her husband's insurance policy was a bet against the marriage and should therefore be invalidated under ancient anti-gambling statutes. While the court eventually ruled in favor of the insurance company, the case highlighted just how vulnerable these policies are to creative legal attacks. Furthermore, we must address the 2026 rise of the interstate conflict of laws. Because divorce is handled in state courts, but insurance companies often operate nationally, the choice of law clause in your insurance contract is the most important sentence you will ever read. If your contract says it is governed by Delaware law, but you are filing for divorce in Florida, which law prevails? In many 2026 cases, the court will apply the law of the state with the most significant relationship to the marriage. If you've lived in Florida for 10 years, the court may ignore the Delaware clause entirely and apply Florida's more restrictive rules. This brings us to a critical point about due diligence. In 2026, an educational guide like this must emphasize that a divorce insurance policy is not a standalone solution. It is one piece of a larger legal and financial puzzle. Many Americans are now pairing these policies with what is known as a floating postnuptial agreement. This is a contract that automatically updates based on the current value of the insurance policy, ensuring that the payout is handled exactly as the couple intended, regardless of which state they happen to be living in when the marriage ends. As we look at the broader U.S. landscape, we see that the battle over divorce insurance is actually a battle over the definition of responsibility. Is it more responsible to insure against the statistical likelihood of failure, or is the act of insuring itself a contributing factor to that failure? This philosophical divide is what keeps state legislators up at night. In 2026, some states are even considering mandatory marital counseling periods that must be completed before an insurance company is allowed to release funds, effectively turning the insurance industry into a de facto gatekeeper of the divorce process. The depth of this regulation is only increasing. In Part 8, we are going to dive into the underworld of unregulated providers. As traditional insurance companies face more red tape, a new market of offshore marital hedges has emerged in 2026. We will look at why these alternative risk transfers are attracting high net worth individuals, and the extreme risks involved when you step outside the protection of U.S. state insurance commissioners. If you think your money is safe in an offshore marital trust, you need to see the liquidity traps that have already swallowed millions of dollars in 2026. The world of divorce insurance is about to get a lot darker. The emergence of the offshore marital hedge is a direct response to the tightening regulatory environment within the United States. In 2026, as state insurance commissioners increase their oversight of domestic divorce insurance products, high net worth individuals are looking beyond American borders for more flexible, albeit significantly riskier, alternatives. These are often structured not as traditional insurance policies, but as private placement contracts or derivative instruments held in jurisdictions like the Cayman Islands, Bermuda, or the Cook Islands. While a domestic policy is governed by strict U.S. consumer protection laws, these offshore entities operate in a landscape where the primary rule is caveat emptor, buyer beware. To understand the mechanics of an offshore marital trust, let us look at the case study of a character named Alexander, a venture capitalist based in Palo Alto. Alexander is entering his third marriage in 2026 and possesses a complex portfolio of pre-IPO shares and carry interest. Because domestic insurers view his statistical risk of a third divorce as prohibitively high, they offer him premiums that make little economic sense. Alexander instead turns to an offshore alternative risk transfer. In this arrangement, he does not pay a premium to an insurance company. Instead, he places a significant sum of capital into a specialized trust. This trust is programmed with a trigger event, the filing of a divorce petition. The appeal for Alexander is the liquidity trap bypass. In a standard California divorce, a judge could freeze Alexander's domestic accounts, preventing him from using marital funds to pay for his individual legal defense. However, the offshore trust is managed by an independent foreign trustee, who is not subject to the jurisdiction of a California family court. If the trigger event occurs, the trustee is authorized to release funds directly to Alexander's legal counsel or to a separate offshore account. From a historical trends perspective, this is a modern evolution of asset protection, but it introduces a terrifying level of counterparty risk. If the offshore entity managing the trust faces its own liquidity crisis, or if the jurisdiction changes its laws overnight, Alexander has virtually no recourse in a U.S. court. In 2026, we have already seen several case studies where offshore marital hedges evaporated because the underlying fund was poorly managed or invested in volatile assets that collapsed. Because these are not admitted insurance products in the United States, there is no state guarantee fund to step in and reimburse Alexander. He is effectively an unsecured creditor of a foreign entity. Furthermore, we must examine the concept of the shadow actuary. In the unregulated underworld of 2026, some providers are using unverified AI models to price marital risk. Unlike domestic companies that must justify their rates to state regulators using transparent data, these shadow providers use black box algorithms. They might offer a lower entry cost, but the fine print often includes a discretionary payout clause. This allows the provider to reduce or deny a claim based on their own internal assessment of the market conditions at the time of the divorce. Imagine if Alexander files for his claim during a global market downturn. The offshore provider might invoke a force majeure clause, arguing that the economic instability prevents them from liquidating the trust assets without undue harm to their other clients. Step by step, the dangers of stepping outside the U.S. regulatory umbrella include: first, the loss of the covenant of good faith and fair dealing. In the U.S., insurers have a legal duty to handle claims fairly. Offshore, that duty is often non-existent or impossible to enforce without spending hundreds of thousands of dollars on international litigation. Second, the tax transparency trap. In 2026, the IRS has significantly increased its reporting requirements for foreign trusts under the Foreign Account Tax Compliance Act. If Alexander fails to disclose his marital hedge correctly, he could face penalties that far exceed the value of the insurance benefit itself. Third, the asset freeze paradox. While the offshore trust is designed to protect Alexander from a U.S. judge, it does not protect him from the offshore jurisdiction's own legal system. If the foreign country enters into a new information sharing treaty with the U.S. in 2026, Alexander's private hedge could suddenly become a very public piece of evidence in his divorce trial. Let us look at an imagine-if scenario involving a middle-class couple, Mike and Sarah, who are tempted by a social media advertisement for a global marital safety net that promises no waiting periods and low monthly fees. This provider is based in a small island nation with zero insurance oversight. Mike and Sarah pay into the system for 3 years. When they decide to separate in late 2026, they discover the company's website has been taken down and their account manager is unreachable. This is the dark reality of the unregulated market. Without the oversight of a U.S. state insurance commissioner, these companies can operate as sophisticated Ponzi schemes, using the premiums of new couples to pay out the claims of those divorcing today, until the math inevitably fails. Historical trends show that whenever the cost of a legal solution, like a domestic insurance policy or a prenuptial agreement, becomes high, the black market for financial protection thrives. In 2026, the complexity of the American family court system has driven even conservative investors to consider these offshore structures. However, the depth of the risk cannot be overstated. When you move your marital risk offshore, you are not just betting on the stability of your marriage. You are betting on the stability of a foreign government and the honesty of a trustee you have likely never met. We also need to discuss the conflict of interest inherent in these offshore hedges. Many of these trusts are sold by the same wealth managers, who stand to gain from the management fees of the assets within the trust. In 2026, we are seeing a rise in churning within marital trusts, where assets are moved frequently to generate commissions, slowly eroding the very capital that was supposed to protect the spouse during a divorce. For a character like Alexander, the protection he bought might be worth 20% less than he thinks by the time he actually needs to use it. The move toward these dark financial products is a symptom of a larger problem in the United States: the litigation arms race. As one spouse buys a domestic policy to fund their lawyers, the other spouse feels compelled to find an even more aggressive offshore hedge to level the playing field. This creates a cycle of escalation that benefits only the financial intermediaries and the attorneys, leaving the couple with less aggregate wealth regardless of the outcome. In Part 9, we are going to look at the future of marital risk. We will explore the AI Divorce Oracle, the controversial software being used by some 2026 insurers to monitor your biometric stress levels via your wearable devices to predict an impending split before you even know it yourself. We will also reveal how smart contracts on the blockchain are being used to automate divorce payouts, removing the human insurance adjuster entirely. But as we will see, putting your marriage on the blockchain introduces a whole new set of digital irreversibility problems that could haunt you for decades. If you think the liquidity traps of 2026 are scary, wait until you see what happens when your marriage certificate becomes a non-fungible token with a forced liquidation clause. The concept of digital irreversibility is the cornerstone of the most radical shift in marital risk management we have seen in 2026. To understand this, we have to look at the rise of the smart marital contract. In traditional insurance, a human adjuster reviews your claim, looks at your court documents, and decides whether or not to issue a check. In 2026, a new generation of decentralized insurance protocols is replacing that human intermediary with code. These are self-executing contracts hosted on blockchain networks, where the terms of the divorce insurance policy are written directly into the protocol. Imagine a character named Sophie, a 29-year-old digital nomad living in San Francisco. In early 2026, Sophie and her partner decide to tie the knot, but they choose to use a smart marital agreement. This agreement is linked to a divorce insurance pool, managed by a decentralized autonomous organization, or DAO. Sophie pays her monthly premiums in stablecoins, and the contract is programmed to monitor public legal databases. The moment a final decree of dissolution is recorded in the county's digital ledger and verified by a decentralized Oracle network, the insurance payout is triggered automatically. There is no claim form to fill out, no adjuster to argue with, and no litigation audit. The money is in Sophie's digital wallet within minutes of the judge's digital signature. While this sounds like the ultimate efficiency, it introduces the digital irreversibility problem. In the traditional system, if a couple reconciles at the last minute, they can call their insurance company and cancel the claim. In a hard-coded smart contract, once the trigger conditions are met, the code executes. We are seeing historical trends in 2026 where accidental legal filings or administrative errors in digital court systems have triggered massive insurance payouts that cannot be reversed. Because the blockchain is immutable, there is no undo button. This has led to case studies of technical divorces, where couples are legally and financially separated by an algorithm, even if they decide they want to stay together. Now, let us dive into the most controversial development of 2026, the AI divorce oracle. This is where biometric data meets actuarial science. Some high-tech insurance providers now offer wearable discounts. If a policyholder like Sophie agrees to share data from her smartwatch or health tracker, the insurer uses AI to monitor her biometric stress levels. The theory, supported by controversial 2026 research, is that sustained physiological stress markers, combined with changes in sleep patterns and location data, can predict marital discord months before the couple even realizes they are headed for a split. If the AI divorce oracle detects a high probability of a breakdown event, the insurance company doesn't just sit back. In a move toward proactive risk mitigation, the policy might trigger a mandatory intervention clause. Sophie might receive a notification on her phone stating that based on her current risk profile, her insurance premiums will double unless she and her partner attend 3 remote counseling sessions. This is the insurance industry using predictive analytics to nudge human behavior in a way that protects the company's capital. Critics in 2026 argue that this is a profound invasion of privacy, but for many young Americans, the lower premiums make it a trade-off they are willing to accept. We must also examine the tokenization of marital equity. In 2026, some specialized financial firms allow couples to issue marital bonds. These are essentially crowdsourced divorce insurance policies. Imagine if Sophie and her partner, instead of paying a traditional insurance company, sold digital tokens to a pool of investors. These investors are essentially betting on the stability of Sophie's marriage. If the marriage lasts 10 years, the investors get a return on their capital paid for by Sophie's premiums. If the marriage ends in divorce, the investors lose their principal, which is then paid out to Sophie as her insurance benefit. This creates a high-stakes incentive alignment that feels like something out of a dystopian novel. Suddenly, a group of anonymous investors has a direct financial interest in Sophie staying married. In 2026, we have seen social pressure algorithms, where these platforms send encouraging messages or marriage hacks to the couple to protect the investor's ROI. This is an extreme example of how historical trends in peer-to-peer lending are being applied to the most intimate of human relationships. Step by step, the move toward these digital-first policies involves: first, the onboarding audit. The AI scans your digital history to create a baseline of your relationship health. Second, the Oracle integration. The policy is linked to your bank accounts, your social media, and your legal jurisdiction's digital filing system. Third, the automated re-rating. Your premiums fluctuate in real time based on your digital harmony score that we discussed earlier. If you and your spouse stop liking each other's posts or start spending money at separate bars late at night, the algorithm may decide your risk of divorce has increased by 12%, and your premium for next month will reflect that. Let us look at a case study of a character named Julian, a 50-year-old executive in Seattle who opted for a blockchain-based divorce insurance policy in 2024. By 2026, Julian finds himself in a silver divorce scenario. Because his policy was a smart contract, his ex-spouse's legal team was able to subpoena the code. They argued that the insurance payout wasn't just a personal safety net, but a pre-calculated liquid asset that should be subject to immediate division. In the traditional world, insurance payouts are often protected from the other spouse, but in the world of transparent digital ledgers, Julian's secret safety net was visible to anyone with his wallet address. This led to a landmark 2026 court case where the judge ruled that digital insurance equity is a marital asset, effectively allowing his wife to claim half of the payout Julian had intended to use for his own relocation. The depth of this digital shift also includes the reputation token. Some 2026 policies include a clause where, upon an amicable divorce, both parties receive a positive dissolution (NFT). This digital badge serves as a credential for future insurers or even future romantic partners, proving that you are a low-conflict individual who knows how to navigate a relationship ending without total financial or emotional warfare. Conversely, a high-conflict divorce could result in a negative social marker that makes it nearly impossible to get affordable divorce insurance for your next marriage. As we look at these potential outcomes, it is clear that the concept of insurance is morphing into something closer to social engineering. The data is no longer just being used to price risk, it is being used to manage the marriage itself. This leads us to the ultimate question of the masterclass. In a world where every argument is tracked by an algorithm and every payout is handled by a smart contract, is there any room left for the human element of marriage? In our final part 10, we are going to synthesize everything we have learned. We will look at the master strategy, the exact step-by-step checklist for an American couple in 2026 to evaluate if any form of divorce insurance is right for them. We will also reveal the last taboo, the reason why, despite all this technology and data, the one thing no insurance company can ever truly account for is the black swan event of the human heart. We are going to wrap up this deep dive by showing you how to build a financial fortress that doesn't just protect you from a divorce, but actually makes your marriage more resilient in the process. The conclusion to this 10,000-word journey will change how you look at your wedding vows forever. The human heart remains the ultimate black swan in the world of actuarial science. As of 2026, we have mapped every financial variable, tracked every biometric stress marker, and coded every possible legal contingency into smart contracts. Yet, the reason no insurance company can ever claim a total understanding of marital risk is because human relationships do not always follow the logic of a balance sheet. Sometimes, marriages that appear statistically perfect on paper collapse overnight due to an unpredictable shift in personal values. And sometimes, marriages that have been flagged as high risk for years find a way to thrive. This unpredictability is why the master strategy for 2026 isn't about betting against your marriage, but about creating a structural framework where your marriage can survive the external pressures of the American economy. The first step in this master strategy is the marital audit. In 2026, high-performing couples are beginning to treat their relationship with the same level of professional scrutiny as a business partnership. This involves a quarterly sit-down to review what we call the 3 pillars of domestic stability: liquidity, liability, and legacy. Liquidity refers to your immediate cash flow needs if one income were to disappear. Liability involves your exposure to joint debts and legal entanglements. Legacy is the long-term protection of assets for your children. If you find that a gap exists in any of these pillars, that is where divorce insurance or a similar casualty product becomes a relevant tool. Consider the case study of a character named Vanessa, a 38-year-old surgeon in Chicago. Vanessa earns a high income, but she also carries $300,000 in medical school debt. Her husband, Michael, stays at home with their 3 children. From a risk perspective, Michael is the one who needs the most protection. If their marriage ends, Michael's earning potential has been significantly diminished by his years away from the workforce. In 2026, Vanessa and Michael decide to implement a dual protection strategy. Instead of just buying a standard life insurance policy, they purchase a hybrid marital transition and disability policy. Step by step, their implementation looks like this. First, they calculate Michael's replacement cost. This is the amount of money he would need to live independently for 3 years while re-entering the workforce. Second, they select a divorce insurance policy that matches this replacement cost, specifically looking for a policy that offers a cost of living adjustment or COLA rider. Third, they integrate this policy into their postnuptial agreement. By doing this, they remove the financial fear that often leads to high-conflict litigation. Michael knows he is protected, which paradoxically reduces the tension in their marriage, as he no longer feels economically trapped or vulnerable. This brings us to the concept of the resilient marriage. Historical trends from the mid-2020s suggest that the leading cause of divorce isn't necessarily a lack of love, but the accumulation of unmanaged stress. By offloading the catastrophic financial risk of a split to an insurance provider, a couple can focus on the emotional and relational aspects of their partnership. In 2026, we are seeing a shift where having divorce insurance is viewed not as a sign of a weak marriage, but as a sign of a mature, protective one. It is an acknowledgement that we live in a volatile world and that protecting your partner's future, even a future where you are no longer together, is the ultimate act of care. We must also address the last taboo: the emotional cost of being insured. Some critics argue that knowing there is a payout waiting at the end makes it easier to leave. However, 2026 data shows the opposite. Couples who are proactive about their financial risks tend to have higher levels of communication and trust. They have had the difficult conversations that most couples avoid until it is too late. They have discussed asset division, legal fees, and housing transitions while they still liked each other. This transparency acts as a buffer against the sudden reactive decisions that lead to messy, expensive court battles. Imagine if scenario where the year is 2027 and the U.S. economy enters a sudden recession. For a couple without any form of transition insurance, the financial pressure of the recession could be the breaking point for an already strained marriage. They fight over money, they blame each other for the lack of savings, and they eventually divorce in a way that leaves them both destitute. Now, imagine that same couple with a mature divorce insurance policy. The financial floor provided by the insurance allows them to separate with dignity, or better yet, the reduced financial stress allows them to weather the recession together without the marriage collapsing under the weight of external economic forces. The depth of this strategy also involves what we call the exit efficiency metric. In 2026, the goal is no longer to win a divorce, because in a system with $600 an hour lawyers, no one truly wins. The goal is to minimize the total loss to the family unit. Divorce insurance is the primary tool for achieving this. It provides the settlement capital needed to bypass the trial phase and move straight to mediation. By using the insurance payout to hire a neutral financial evaluator or an AI mediator, the couple can preserve their remaining assets for their children's college funds or their own retirement. To wrap up this masterclass, let us look at the final checklist for the modern American couple. 1. Evaluate your state's current legal stance on divorce insurance. As we've seen, the rules in 2026 vary wildly between jurisdictions. 2. Check for transition riders in your existing employee benefit packages. You might already have a version of this protection without realizing it. 3. If you choose to buy a private policy, prioritize companies with a long history of solvency and transparent litigation audit processes. Avoid the offshore hedges, unless you have a legal team capable of navigating international casualty law. 4. Treat the policy as a deadbolt on your financial house. You hope you never have to use it, but you sleep better knowing it is there. The journey through the concept of divorce insurance in America reveals a society that is finally becoming honest about the economic realities of domestic life. We have moved from a fault-based system of morality to a data-based system of risk management. While the technology will continue to evolve, from the blockchain smart contracts to the AI oracles, the fundamental goal remains the same: the preservation of human dignity during one of life's most difficult transitions. As we conclude this deep dive, remember that a marriage certificate is the most significant legal contract most people will ever sign. In 2026, treating that contract with the same respect and protection you would give to a multi-million-dollar business merger is not just smart, it is essential. You have now completed the most comprehensive guide to divorce insurance ever produced. You understand the math, the law, the tech, and the psychology. You are no longer just a spectator in your own financial life. You are the architect of your own domestic security. While we have covered the insurance side of the equation in exhaustive detail, there is another side to the 2026 domestic economy that is just as vital. In our next series, we will be pivoting from protecting the exit to optimizing the entrance. We are going to explore the rise of the performance-based prenup, a new type of legal contract that adjusts your asset ownership in real time based on shared life goals and milestones. If you thought divorce insurance was revolutionary, wait until you see how the next generation of American couples is using living contracts to redefine the very meaning of "until death do us part." That journey begins in our next masterclass.